Want to bring in Ananya Lodaya. She is portfolio manager for international growth equities at Invesco. And Ananya, everybody's trying to figure out if these gains will continue and even push further ahead for next year. What are your thoughts?
Well, Becky, I'm not particularly surprised by the market reaction, considering that the biggest overhang for the past 18 months or even longer has been the Fed pulling away the punch bowl of easy money and all the withdrawal symptoms that's led to. So for the Fed to come out and almost officially blow the all-clear siren is a reasonable basis for optimism. Can it continue from here? I think you have to look under the index levels and look at individual stocks, because there are definitely plenty of very good fundamental stories out there at not egregious valuations, and those, I think, will continue to have a constructive backdrop.
Okay, here is the weird thing. Everybody was so wrong last year as we were heading into this year. Everybody was looking for some serious sort of recession, some serious slowdown. It didn't happen. Why should I feel any better that everybody now seems to think that next year's going to be okay because the Fed has made this pivot?
Yeah, no, I hear you, right? We came into this year with the experts almost willing us into a recession because there was so much scar tissue from 2022. But the economy and the data have just proved to be much more Goldilocks-like, not too hot, not too cold. Can that continue? Here's what I'll say, right, in terms of what we know. The market is a very complex, adaptive machine, and that's the part people missed. A year ago, people thought by this time Europe would have run out of gas. That didn't happen because they adapted. People thought, banking crisis, but they didn't realize the Fed has, or I think they didn't bake in the fact that the Fed has learned from previous missteps, and so this was much more quickly contained. And so I think the point people are missing again is, of course, there'll be unexpected surprises, but the market adapts very, very quickly. So it's not really going to rhyme with whatever historical data point by extrapolating from.
I mean, that's a fair point, but how much of it is the market is adaptive and how much of it is government stimulus and central banks were here to cushion any potential fallout the whole way through? Because, the Fed may have been raising rates, but they also acted very quickly to be accommodative when we had the banking issues back in the spring.
Yeah, I think we've had very constructive institutions. That's certainly been helpful. But the biggest driver of this resilience has been a strong consumer, very good balance sheets, right? I'm sure there are pockets of excess, but overall, we do not have any structural misallocation of capital going into this or coming into this year. And a labor market that's really held up well. So I would say that the economic data has trundled along pretty well. And why did people miss it? I think partially it might have been because we came out of COVID with a lot of the time series looking pretty wonky. And so I think there may have been some confusion about where we are in the cycle.
Where do you see bargains or valuation deals at this point? Do you see any?
Yeah, we're very excited about growth equities, particularly in the international markets. Thematically, we look for companies that have durable growth tailwinds where we think they can compound for a while. Things like, themes like mass affluence, technology, aging, just durable, evergreen forces that are pushing economic activity for the next 10 years. And within sectors, there are plenty of sectors that have been beaten down through the rate cycles. IT services, life science tools, where now that the backdrop is supportive, we think fundamentals will reassert themselves.
That means you do what? You're allocating even more internationally for these growth areas, or what happens?
So I'm an international portfolio manager, so international is pretty much all I do. But I think there are lots of reasons to be excited about international, even if the world is your oyster, right? So there are parts of the economy that are simply not available to invest in the U.S. public markets, luxury goods being one. The semiconductor supply chain, that's very ex-U.S. So there are definitely, if you want to hold a global portfolio where you have best-in-class performers, international has got to be a part of the allocation.
Do you look at a specific country or region, or it really is more luxury themed or semiconductor chain themed?
I look at anything where I think the net present value of the future cash flows is below today's price, right? And the areas that I find very interesting right now, or we find interesting right now, tend to be developed Western markets. The UK is cheaper than it's ever been on a relative basis, whereas there are a number of assets there that are compounding really well. There are parts of France, Germany, et cetera, that all have very compelling companies.
Well, if you look at, let's just say Europe in particular, how much of this do you have to figure out what's going on with the central banks? And does Europe have to follow, the European Central Bank have to follow the lead of the Federal Reserve here, or risk getting crushed with valuations for currency?
If you're doing fundamental bottoms-up stock picking, you want the backdrop to be constructive, but the real oomph is going to come from the companies and the earnings that they compound. And so that's what someone trying to create wealth through holding equities for a long time should really focus on. Now, as far as the backdrop goes, I think there's a lot of reasons to feel that it's going to be constructive, right? We've seen the Fed come out basically and pivot effectively. The European banks have been slower to follow. I think today's headlines are all about how they're a little more hawkish. But to your point, historically, the evidence would suggest that if the Fed pivots in one direction, it's hard for other central banks to hold out, just because so many things are dollar denominated.